You spend April 14th hunched over your kitchen table, chasing receipts, trying to figure out if you can deduct that charitable donation from 3 years ago. Meanwhile, a billionaire just paid less in taxes than you did, and they did it legally. This isn't a conspiracy theory. This isn't about offshore accounts or shady loopholes. This is about a strategy so simple, so elegant, and so perfectly legal that it's been hiding in plain sight for over 100 years. Today, I'm going to show you how it works. Not because you can use it tomorrow, but because once you understand it, you'll never look at wealth, taxes, or the financial system the same way again. Most of us think the tax system works like this. You earn money. You pay taxes on what you earn. You save what's left. You invest what you can. And when your investments grow, you pay taxes on the growth. That's the deal, right? You work, you pay, you save, you pay again. It's the cycle that most Americans accept as normal. I earn $1,000. The government takes $250. I invest the remaining $750. It grows to $1,500. I sell. The government takes another $150. I'm left with $1,350. I earned $1,000. I paid $400 in taxes. I kept $600 of growth. That is the deal for most of us. But there's a parallel system. A system that doesn't show up in your TurboTax tutorial. A system that wealthy people have been using for generations. And it operates on a completely different set of rules. The strategy has a name. 3 words. A law professor at USC coined it in the 1990s, not to help rich people get richer, but to explain to his students why our tax system seems so fundamentally unfair. He wanted them to understand the game they were about to enter. Buy, borrow, die. Let's start with the first word, buy. Most people earn income, pay taxes on that income, and then spend or save what's left. The wealthy flip this script. They buy assets first, not with after-tax dollars, with pre-tax growth. Here's what that means. When you buy a stock that doesn't pay dividends, you pay no taxes on that stock until you sell it. It can sit there for years, decades even, growing in value, and the government doesn't touch a penny of that growth. You don't pay taxes on a tree while it's growing. You pay taxes when you cut it down and sell the wood. Same with assets. Stocks that don't pay dividends. Real estate that appreciates. Art that increases in value. Private company shares. Venture capital investments. All of it can grow tax-free as long as you hold on to it. Now you might be thinking, that's not fair. I can do that too. I can buy stocks and not sell them. And you're right. Anyone can do that. The difference is scale. The wealthy have enough assets that they can live off the borrowing against those assets without ever selling them. Most of us don't. But let's get concrete. Let's say you have $1 million. Not a fortune by wealthy standards, but enough to see how this works. You invest that $1 million in a diversified portfolio of growth assets. No dividends, no interest payments, just appreciation. At 7% annual growth, after 10 years, you have nearly $2 million. After 20 years, nearly $4 million. After 30 years, over $7.6 million. And you've paid 0 taxes on that growth over those 30 years. Not a single dollar, because you haven't sold anything. The government has no claim on money you haven't realized. This is the first pillar of the strategy. Buy assets that grow. Hold them. Let time do the work. Don't interrupt the compounding with unnecessary tax events. Now we get to the second word, borrow. This is where the strategy gets really interesting and really unfair. You have $4 million in assets, but you can't pay your mortgage with stock certificates. You can't buy groceries with unrealized gains. You can't take a vacation with a portfolio statement. So how do you access that wealth without selling and triggering a massive tax bill? You borrow against it. Banks love wealthy people. They will happily lend money against a portfolio of stocks, bonds, real estate, or other assets. These are called securities-based lines of credit. And the IRS has a funny rule about borrowed money. It's not taxable. Borrowed money is not income. It's a loan. You have to pay it back, so the government doesn't tax it. Let that sink in. You can borrow millions of dollars against your assets, use that money to live on, buy houses, take vacations, fund businesses, pay for private school, and pay zero taxes on any of it. Here's how the math works. On a $4 million portfolio, a bank might lend you 70% of the value. That's $2.8 million in cash. Tax-free. The interest rate might be 6%, so you're paying about $168,000 a year in interest. But your portfolio is still growing. At 7%, it's earning $280,000 a year, so you're actually making $112,000 a year while living off borrowed money. Your wealth is growing faster than your debt. You're not paying taxes. You're not selling assets. You're just living. And your net worth keeps climbing. This is why wealthy people can have zero taxable income and still live like royalty. They're not earning income. They're borrowing against wealth. The IRS has nothing to tax because there's no transaction to tax. The government taxes transactions, selling, earning, receiving dividends. But borrowing? Not a transaction they can touch. Now for the third word, die. I know. It's morbid, but stick with me. This is the part that will really make you question everything. You've spent decades borrowing against your assets, living well, paying no taxes. Your portfolio has grown from $1 million to $8 million. You have several million in outstanding loans. Now what? When you die, something magical happens in the tax code. It's called stepped-up basis. Here's what that means. Your heirs inherit your assets at their current market value, not at the price you paid for them. All those decades of capital gains, they disappear. For tax purposes, it's as if your heirs bought the assets at today's prices. Let me give you an example. You bought stock for $10 a share 50 years ago. It's now worth $500 a share. When you die, your heirs inherit that stock as if they paid $500 a share. They can sell it immediately and pay zero capital gains taxes. All that appreciation, all those decades of growth, tax-free, forever. Your heirs can sell enough assets to pay off the loans you accumulated over your lifetime. The remaining assets become their inheritance, tax-free. Think about what this means. You lived like a king, paid almost nothing in taxes, and your heirs get millions. Also tax-free. The government never gets a cut of any of it. This is why dynastic wealth exists. This is why some families stay wealthy for generations. The tax code doesn't just allow it, it encourages it, it rewards it. The stepped-up basis rule is not a loophole. It's not an accident. It's been in the tax code for generations. Lawmakers know about it. They've chosen to keep it. Let me walk you through a full example. Because the numbers are staggering. They might make you angry, but you need to see them to understand the scale of what's happening. Meet David. David is 40 years old. He has $1 million in assets, not from inheritance, not from winning the lottery, from building and selling a business. He could pay taxes on that $1 million, but he doesn't. He invests it. Over the next 40 years, his portfolio grows at 7% annually. By age 80, that $1 million has grown to nearly $15 million. He's paid zero taxes on that growth because he never sold. During those 40 years, David needs to live. He doesn't have a salary anymore. He's not working, so he borrows against his portfolio. At age 80, he might have $6 million in outstanding loans, but his portfolio is worth $15 million. He's lived well for 40 years, traveled, helped his kids, enjoyed his life, and his net worth still grew from $1 million to $9 million after debt. Now let's compare this to the traditional approach. If David had sold assets each year to live, he'd pay capital gains tax every time at 23.8%, 20% federal plus 3.8% net investment income tax. That's about $3.5 million in taxes over his lifetime. By borrowing instead of selling, he saves that $3.5 million. His estate is $3.5 million larger, and when he dies, his heirs inherit the full $15 million at stepped-up basis. They sell $6 million worth of assets to pay off the loans. They pay zero taxes on that sale. The remaining $9 million is theirs, tax-free. David started with $1 million. He lived well for 40 years. His heirs got $9 million, and the total tax bill on everything? Close to zero. This is not a hypothetical. This is happening every day. This is how generational wealth is built and preserved. Now, I need to be painfully honest with you. This strategy is not available to most people, and that's probably the most frustrating part of all. You need a certain amount of wealth to make this work. Banks won't give you a securities-based line of credit on a $50,000 portfolio. The fees alone would eat you alive. The paperwork wouldn't be worth it for them. The minimum to play this game is usually around $1 million in investable assets. For the best terms, you need $5 million or $10 million. This is why wealth inequality is so sticky. The rich don't just have more money, they have access to financial tools that don't exist for everyone else. Tools that help them keep more of what they earn and grow more of what they keep. The people who need tax relief the most, middle-class families, struggling workers, small business owners, teachers, nurses, get the least. The people who need it the least get the most. It's not that the system is broken. It's that the system is working exactly as designed. And it was designed by and for the wealthy. But here's what you can learn from this strategy, even if you can't use it yet. First, focus on assets that grow, not just income that gets taxed. Dividends and interest are tax inefficient. Appreciation is tax deferred. The wealthy prefer growth over income for a reason. Second, understand that debt isn't always bad. Borrowing against assets can be a tax-efficient way to access liquidity. The key is having assets to borrow against. Build the assets first. Third, the stepped-up basis rule applies to everyone. If you have assets when you die, your heirs get that tax benefit. It's not just for billionaires. It's for anyone who owns assets worth passing on. Finally, don't hate the player. Hate the game, but learn the rules, because the rules are the same for everyone. Some people just know how to use them better. Now you know too. I want to talk about something that doesn't show up in the math. The psychological impact of learning this. When you discover that the tax system is not what you thought it was, it's easy to get angry. It's easy to feel cheated. It's easy to feel like the game is rigged and there's no point in playing. Don't give up. Yes, the system is tilted. Yes, the wealthy have advantages you don't. Yes, it's unfair. But stewing in the unfairness won't put a single dollar in your pocket. Anger without action is just stress. What will put dollars in your pocket is understanding the rules, not complaining about them. Understanding them and using them as best you can. You may not be able to get a securities-based line of credit tomorrow, but you can open a Roth IRA. You can invest in tax-efficient index funds. You can hold assets for the long term. You can learn. The gap between the wealthy and everyone else isn't just about money. It's about knowledge. It's about knowing the rules of the game. Now you know one of the biggest rules. Use it. The wealthy didn't get where they are by complaining about the system. They got there by understanding the system and using it to their advantage. You can do the same at your own scale. Let me lock this in with a quick recap, because these 3 words are the key to understanding how the wealthy think about taxes. Buy. Wealthy people focus on assets that grow without producing taxable income, stocks without dividends, real estate that appreciates, art, private businesses, venture capital. All of it grows tax-free as long as they hold it. Borrow. Instead of selling assets and paying capital gains tax, they borrow against their assets. Loans are not taxable income. They live off borrowed money while their assets keep growing. Die. When they pass away, their heirs inherit the assets at stepped-up basis. All the accumulated capital gains disappear. The heirs can sell assets to pay off the loans and keep the rest. Tax-free. Buy, borrow, die. 3 words, 1 strategy. Decades of tax-free wealth building. It's not illegal. It's not a loophole. It's the law, and it's been on the books for generations. Now, I know some of you are frustrated. You're thinking, this is great for billionaires, but what about me? I don't have $1 million. I don't have assets to borrow against. Fair question. Here's what you can do. Right now, today, without a private banker. First, max out your tax-advantaged accounts. 401k, Roth IRA, HSA. These are the poor person's version of the buy, borrow, die strategy. They let your money grow without being taxed along the way. The wealthy use securities-based lines of credit. You use a Roth IRA. Same principle, tax-free growth, different scale. Second, hold investments for the long term. Every time you sell, you trigger a taxable event. Every time you hold, you defer taxes. Deferral is powerful. Deferral is how the wealthy stay wealthy. Third, understand stepped-up basis. If you have assets when you die, your heirs get that benefit. It's not just for the rich, it's for everyone. Even a small portfolio passed to your kids gets this treatment. Fourth, don't be afraid of debt used strategically. Borrowing to buy assets that grow faster than the interest rate can be smart. The wealthy do it all the time. You can do it too, at your own scale. Fifth, focus on building assets, not just earning income. Income gets taxed, assets grow. The wealthy are wealthy because they own things, not because they earn salaries. Finally, educate yourself. The more you know about how the tax code actually works, the better decisions you'll make. The wealthy know the rules. Now you're starting to learn them too. The buy, borrow, die strategy isn't a secret. It's not a conspiracy. It's just the tax code working exactly as written. Some people use it. Most people don't even know it exists. Now you do. You may not be able to use it tomorrow, but you can start building assets. You can start learning the rules. You can start playing the game differently. The gap between you and the wealthy isn't just money, it's knowledge. Now you have some of that knowledge. Use it. If this video opened your eyes, hit that like button. It helps more people find it. And subscribe if you want more videos about how money actually works. Not the fantasy, the reality. Not what they want you to believe, the truth. Now I want to hear from you. Drop a comment and tell me, did you know about stepped-up basis before this video? Did you know that borrowed money isn't taxable? What's the most surprising thing you learned today? Be honest. Be specific. Let's fill the comments with real reactions. Maybe your comment will help someone else understand this for the first time. I read them. I'll be in there. Let's figure this out together. Thanks for watching. Learn the rules. Play the game. See you in the next one.